Gold hits an unprecedented high amid global economic uncertainties. Kenya looks east as President Ruto visits China as trade, debt and diplomacy take centre stage. And Singapore braces for an economic slowdown as officials launch a task force to weather tariffs and trade war turbulence. Hello, I'm Taiba Aiden with the latest business and finance news here on TRT World. Gold prices surged to a new record high on Tuesday as the US dollar and equities fell amid growing economic uncertainty. The bullion soared past $3,480 per ounce over US President Donald Trump's threats against the Federal Reserve's independence and his tariffs shake investor confidence. The dollar fell to a three-year low against a basket of its big trading partners after Trump stepped up his criticism of Powell, whom he called Mr. Too Late for not cutting rates, also sparking a fresh sell-off on Wall Street. Let's get more on this now with Farah Murad in Dubai. She's a senior market analyst at Equity Group. Good to have you with us, Farah. Now, we're seeing the dollar and US equities tank. Does this indicate that investors have lost confidence in the US economy, or is it just a short-term reaction?
Thank you, Taiba, for having me. And it's a weird thing to see, by the way. Usually we either see US dollar being supported, pressuring other US assets such as the stock market, or the other way around. Now, is it a long-term trend or a short-term reaction? I would say it's a mix of both. We're not seeing a total loss of confidence in US assets yet. I think it's a tactical retreat at the moment. Markets are pricing a shift of interest rate policy, global inflation as well, this trade war also continuation. So I think it's more a hedge against the high volatility, more than a total abandoning of US assets. But if this trend continues, then we might see it shifting into something more structural, yes.
Right, and let's look at gold prices now. You previously mentioned that you expect it to hit as high as $5,000 this year. How soon do you see that happening?
It really all depends on the current dynamics and how they will accelerate. The main things we need to check the de-dollarization trend. Also the capital shifting from sovereign debt into hard assets. This kind of debate between the federal bank and Donald Trump, how it will affect interest rate policies. It is possible to see it mid-year in case all these dynamics continue to accelerate. In extreme fear scenarios, you might even see the 5,000, but at the moment, 4,000 seem more possible with the current dynamics. We need to remember as well, the main thing is in case we see real yields going back into the negative territory again, that's something that would give us another signal that gold might be supported. We need to remember the current trend, the cornerstone of it is the demand of central banks. Retails are only catching up.
Now, the IMF and World Bank spring meetings are taking place at the moment with a special focus on trade tensions. Do you expect the IMF to downgrade its outlook for this year?
It's definitely possible. I mean, we saw also a downgrade in January from 3% of possible global growth to 2.2%. Given the pressure that we might see on transportation, on supply chain, on maybe even commodities, yes, it's possible to see also a downgrade. I don't think it's going to be a huge or maybe like a dramatic change of outlook. Maybe we might see it lower to 2%, 1.8%, nothing dramatic, but something clear enough to highlight the effect of the current trade tariff and the supply chain changes on the global economy.
Right. Farah Murad, Senior Market Analyst at Equity Group. Thank you very much for your insights.
Thank you for having me.
Now, analysts have slashed Singapore's 2025 growth forecast from 0 to 2% from a previous 1 to 3%. In response to escalating US-China trade tensions and 10% tariffs on Singaporean imports, the government has launched a task force to bolster economic resilience. Emma Boz reports.
Desperate times call for decisive action. In Singapore, authorities are assembling a team to navigate the economic storm triggered by US President Donald Trump's trade policies.
Given these significant uncertainties, PM has asked me to set up this Singapore Economic Resilience Task Force to help our companies, especially our small and medium-sized companies, to navigate through these troubled waters.
The task force is focusing on three key areas to navigate the economy during these turbulent times. The first area is improving communication to keep businesses and workers better informed. The second area involves addressing immediate challenges like job security and business support. This will be done by encouraging flexible workforce strategies to maintain employment. The third area looks at developing long-term strategies to explore new growth markets, boost competitiveness, and support innovation in industries. Singapore's economic growth has been sluggish since early last year. While the economy grew by 3% in the third quarter of 2024, it contracted in the first quarter of this year. The ongoing trade war and global economic uncertainty are expected to worsen conditions.
In fact, some companies in Singapore are already being affected. For example, those who have manufacturing operations in China or sell to manufacturers in China for onward sales to the US are already seeing cancelled orders or deferred orders. This dangerous game of brinksmanship between the US-China also risks greater tension that can easily spill over to other countries and other areas.
Singapore's officials hope this strategic task force will yield long-term economic dividends. Emre Boz, TRT World.
We're now joined by Ibrahim Sufyan in Kuala Lumpur. He's the director of the Merdeka Centre for Research. Welcome back to TRT World, Ibrahim. Now, with Singapore's growth slashed for this year, how serious is the threat to long-term economic stability?
Well, I think the threat to Singapore's long-term economic stability is moderate, in the sense that Singapore has a developed economy and its reliance on goods trade is only a small fraction, maybe about 20 to 25% of its GDP. And a lot of the business volume that is generated out of Singapore is due to services. But having said that, I think the Singapore government is taking a very prudent and cautious stand. Particularly, the country is going through a general election coming up soon on May 3rd. So I think the government is putting across communications to the public that is meant to manage public expectations and also to prepare them for what could be a long drawn-out affair of economic instability and uncertainty, given that we have not even reached the 100-day mark of the Trump administration.
And what role will the Economic Resilience Task Force play in protecting small businesses and jobs amid these global tensions?
Yes, I think the task force has a very interesting role. Its role is threefold. Number one, it is to help improve the clarity of government communications to Singapore businesses and also the workforce. So it's meant to manage public expectations. Number two, it's also meant to identify pain points in the Singapore economy and the workforce and to work very quickly to address them. I think Singapore is in the forefront for this. They're well known for their government efficiency. And finally, and I think this is important, is for them to develop long-term strategies and responses to diversify trade partners and find opportunities that can leverage on Singapore's strength as a financial services and also logistics hub. So it's meant to identify ways that they can diversify supply chains and also strengthen its commitments to the financial industry.
And how are Singaporean companies with Chinese ties navigating these tariffs?
I think these are trying times for Singapore companies with Chinese ties. I think there are a number of them. Some companies have China-based investors. So big tech giants of China like Alibaba, Tencent, and ByteDance have partners and also investments in Singapore-based firms. Other firms are doing manufacturing and selling back components to China. And this happens to be Singaporean companies that are involved in the electronics trade industry. I think in the case of access to semiconductors, which accounts for a big part of the goods trade of Singapore, there is currently a reprieve in the sense that there is a moratorium on semiconductor products have not yet been put on a tariff list, but eventually this may come. So these companies will endure closer scrutiny. I think the radar or the focus is going to be on Singapore firms that will be used to circumvent tariffs imposed on China, as well as Singapore firms that may be diverting or selling products to China that are on an export restriction list, such as what happened in January this year, where 2 Singapore firms were placed on the list for allegedly selling components to China companies such as Huawei and other military-linked companies.
And can diversifying markets really offset the impact of the US-China trade war?
I think it can. I think in the case of Singapore, unlike many other countries in Southeast Asia, Singapore's exposure to the US, while large, is not a big component of its overall economy. And at the same time, Singapore only attracts a 10% baseline tariff. Other countries in the region have much larger or higher tariff rates. And if we include the exemption list into the tariff list, nearly 60% of the export items coming out from Singapore are actually not subjected to tariffs right now. But be that as it may, I think Singapore will continue to diversify. It can leverage on its strong links in the financial industry. It can attract new investors, as well as companies that are trying to move away and seek safe havens in this ongoing trade war. And I think while trade volumes may decline a little, but I think in the grand scheme of things for Singapore, the impact is quite mitigated because they have a well-diversified economy.
Ibrahim Sufyan in Kuala Lumpur, thank you very much for joining us.
Thank you.
Now a quick look at some of the other top business stories from around the world. China exported 1.5 million cars in the first quarter, up 16% from last year. In March alone, 570,000 vehicles were shipped abroad. The jump shows China's growing power in the global auto market. But economists warn that new US tariffs could drive up prices and slow exports in the coming months. Saudi Aramco and Chinese EV giant BYD have joined forces to develop new energy vehicle technologies. The deal aims to boost innovation in cleaner engines and improve transport efficiency. It's part of Saudi Arabia's push to grow its green car sector and reduce reliance on oil. Financial services group Nomura is set to acquire Macquarie Group's US and European public asset management units for $1.8 billion. This marks the Japanese brokerage's largest overseas deal since its purchase of Lehman Brothers assets in 2008. Following the announcement, Macquarie's shares rose 1.6%, while Nomura edged up by 0.1%. And US pharmacy chain Walgreens has agreed to pay $300 million to settle allegations that it improperly filled millions of opioid prescriptions, according to the Department of Justice. The company will make the payment over 6 years with an additional 4% interest each year. If Walgreens is sold or merged before 2032, it could owe up to $50 million more. Kenyan President William Ruto is on a 5-day state visit to China, where he will discuss debt payment and infrastructure financing with his host Xi Jinping. The visit comes at a time when the United States and China are locked in an escalating trade war, as Beijing warns countries against striking deals with the US at its expense. Grace Courier-Kanji has the details.
If you look at that, China, first row, China.
Kenya seeks leverage on the tit-for-tat standoffs between Washington and Beijing, marked by fast-moving tariff policies. Experts argue that Trump's reciprocal tariffs, which imposed a 10% minimum baseline tariff on all imports, will push many African traders away and turn them east.
Business people, especially from Eastern Africa, they'll now try to find an option to export the goods because the trade must continue to go. So they'll trade more with China. They'll trade more with China because they'll find that trading with the United States is now very expensive for them.
Distinguished guests,
President Ruto last year also made a state visit to the U.S. at former President Joe Biden's invitation. The Kenyan president and other leaders might now have to tread carefully with the partnerships they make.
It should be pointed out in particular that China firmly opposes any party reaching a deal at the expense of China's interests. If this happens, China will never accept it and will resolutely take countermeasures in a reciprocal manner.
China commands a strong presence in Africa. It has become sub-Saharan Africa's largest trading partner, according to the International Monetary Fund, as well as the region's major credit provider. In 2015, trade between China and Africa stood at $179 billion and has risen to $295 billion in 2024, according to China's General Administration of Customs. And it's pushing for more.
China will help African countries train 6,000 military personnel and 1,000 police officers and law enforcement personnel. China will also continue to support the construction of Africa's standing army and rapid forces.
Africa is a key part of Beijing's Belt and Road Infrastructure, or BRI, projects. China has built Africa's longest suspension bridge in Mozambique, funded projects like Kenya's Nairobi to Mombasa Standard Gauge Railway and the Abuja Light Rail in Nigeria. Most of the projects on the continent have been financed through Chinese public bank loans, funds that have led to deepening debt in some countries. While in Beijing, President Ruto also hopes to sign bilateral agreements on manufacturing, technology, climate change and agriculture. Grace Kuriakanja, TRT World.
Joining us now for more is Churchill Aguto, who's an economist at IC Group in Kenya's capital, Nairobi. Now, Churchill, we know President Ruto is more Western-centric. We saw images of him in the White House and more. How is the president balancing Kenya's relationships with both the US and China during this strategic visit?
Thanks. From my view, the president's engagement with these two superpowers is largely to diversify its global partnership and rather not to be drawn into the bickering between China and US that is playing out at the moment. And also you find that there's some complementary benefits that Kenya is getting from engagement with both of these bilateral partners. With the US last year was the Strategic Trade and Investment Partnership, and also piggybacking on the fact that Kenya is a regional diplomatic hub. And with China, obviously, the play that is there is now Kenya is part of the Belt and Road Initiative that China is trying to develop. So it's pretty much a diversifying affair. And also let me throw in another angle that this visit this week is coinciding with the ongoing IMF and World Bank spring meetings. And this is on the back of the program that lapsed early this month that Kenya was not able to finalize. So the argument can be made is that also Kenya is also trying to look at other financing sources away from the Bretton Woods institutions.
And with Africa's trade volume with China almost doubling in the last decade, do you think Africa is becoming too dependent on Beijing's financing?
I think the play here is that China is hedging itself with the increased trade that we have seen between it and Africa. So that naturally comes at to hedge itself there's also higher financing from China to Africa. But what we have seen of late is that the scale of financing to Africa has somewhat reduced compared to mid last decade, in the sense that even the Forum on China-Africa Cooperation Summit that was held last September, the amount that was announced was around $50 billion. And then the skew of that, 30 billion of that was now towards credit financing. So that means that the kind of the financing from China has moved away from the large infrastructural projects that we saw mid-2010s levels has reduced. So, and it will be like on a country by country specific. So the kind of engagement has also shifted somewhat as compared to what was at play sometime 15 years ago.
And given that China has warned against deals at its expense with the US, what risks do African leaders face when engaging with both superpowers?
Yeah, I think the risk that is playing out is that we expect that amidst the tariff wars that is playing out, African countries will start negotiating with the US, and China obviously is warning against the deals that will be negotiated with the US that will now tip the scale against China. But I think that risk is somewhat overblown in the sense that the kind of engagement that China is providing to Africa is different from what they can also potentially get with this engagement with the US. So that is a bit overblown. And also, you find that even China is coming at a point whereby even as it negotiates with African countries or within the financing, there are some lessons that it is also learning from some of the defaults that we've seen Ethiopia and Zambia, which were heavily lent by China, and also the debt servicing that we're seeing with Angola. So China is also a cautious borrower, lender rather, in its engagement with China. So I think those will be the dominant themes that will be playing out as Africa engages both superpowers.
And with Trump's tariffs still influencing trade, how much has East Africa shifted its focus away from the US?
To be honest, it's still early to call. And the kind of East African engagement with the US in terms of trade was largely under the AGOA, African Growth and Opportunity Act, which is still up for review in September when it's coming to lapse. So, but from the rhetoric that we've heard from the Trump administration, by all means, I don't think that the AGOA will be renewed past its expiry in September 2025. But then again, if you look at it in terms of what the trade tariffs rhetoric is trying to...
We will have to leave it there, unfortunately. Thank you very much for your analysis.
Thank you. Thank you.
The Trump administration's escalation of the trade war with China has put the US supply of rare earth minerals at risk. Beijing has responded to Washington's tariffs with its own levies, but has also deployed another economic weapon, and that is China's ability to control the global supply of what it's mining. Craig Boswell has more from Washington.
The mining, processing, and refining of rare earth minerals has transformed the world.
Rare earths and rare earth magnets underpin all of modern technology. And without them, many of the things that we use day to day cease to exist.
There are 17 rare earth elements, and they're crucial components in smartphones, motors and electric vehicles, semiconductor chips for artificial intelligence, to medical equipment like MRIs, to fighter jets and guided missiles. In response to U.S. President Donald Trump's tariffs, China, which controls 90% of the processing of rare earths, imposed export controls on many of the critical elements. Experts say these tariff escalations are now more than a trade war.
I would describe it as an existential conflict for global domination in the critical mineral space.
The U.S. has one operational rare earths mine. A handful of companies are trying to deliver alternative sources to reduce reliance on China.
We're working on the entire supply chain, so mine, processing, metals, magnets.
Joshua Ballard's company has a unique rare earths mine in West Texas.
So everything that was listed in those China export controls, that's what's at that deposit.
But getting minerals like neodymium, cerium, and others into the supply chain could take several years. President Trump is attempting to streamline the permitting and financing of U.S. mining projects and step up the mineral security partnership with allied nations. But there's an issue.
Big tariffs against countries like Australia and Canada are counterproductive if you're trying to source critical minerals there.
Some manufacturers are considering redesigns to avoid the import of rare earth elements, but engines and the magnets used to drive much of the technology will be heavier and less efficient. Craig Boswell, TRT World, Washington.
Turkey has taken a major leap in its space journey after commissioning Tuksat 6A, the country's first domestically produced communications satellite. Launched into orbit last year, it's now officially entered service. Aslı Atbaş has more from Ankara.
Ya Allah! Bismillah!
A new chapter begins in Turkey's space story. Tuksat 6A, the country's first domestically produced communication satellite, is now officially in service, expanding Turkey's reach beyond Earth's borders and adding strategic value to Turkey's growing space ambitions.
With this revolutionary project, we now have a local and national communication satellite platform. By establishing a satellite production ecosystem with subcontractors as well as main stakeholders, we've enabled many of our institutions and organizations to contribute to the space industry. With the equipment developed by the project stakeholders, we've reached the level of being able to compete on an international scale and have further strengthened our export capacity. With a coverage area that includes more than 60% of the world's population, that is, a population of 5 billion people, we've become one of the leading countries in space studies and satellite broadcasting.
TürkSat 6A was launched into orbit aboard a SpaceX Falcon 9 rocket last July. After reaching its designated position at 42 degrees east in December, it now provides wide-range coverage from Europe and the Middle East to as far as Southeast Asia, reaching up to 5 billion people.
The jewel in the crown of commissioning TürkSat 6A is that our military and civilian communication capabilities will be much more reliable. For some time, we have been holding on to the blue homeland narrative, aiming to protect our interests in the seas around Turkey. Now we also need to protect our interests in space. We need enough sphere of influence in space to have a greater influence in the world. Now we have TürkSat 6A to do this. We have moved up to the next level. We will continue to produce satellites and export it to countries that need it.
The satellite was developed over nearly 2 decades by leading Turkish institutions. With a record high level of domestic production and engineering talent, the project puts Turkey among just 11 countries capable of building communication satellites. Officials say this is just the beginning of a long-term space vision. As TürkSat 6A begins its service, Turkey strengthens its position in the global space race. A journey not just towards orbit, but towards independence, innovation, and international influence. Aslatbaş TRT World, Ankara.
And that's all your business news for now. Thanks for watching.